Welcome back. We're in Chapter 8, and this is the second video. This covers Learning Outcome 8-2. And I want to flip back for a moment to page 1 of our notes, just to do a quick review. In 8-2, what we're showing you is the allowance method, which is required by generally accepted accounting principles. There's two objectives when accounting for accounts receivable: to report the accounts receivable on the balance sheet at the amount the company really expects to collect, and to match the cost of bad debts to the accounting period in which the credit sale is made. So we can satisfy both by following the allowance method. There's two steps to this: to record the estimated bad debts in the period the credit sales occur. And the reason why we have to estimate is we don't know which accounts receivable account is not going to be paid. We don't know what customer is going to fail to pay us. And we also don't know how much we will not get paid. So we have to estimate that. That's this entry here. It's an adjusting entry that we do before we do our financial statements. And there's two ways to estimate this amount for this journal entry. The first is called the percent of sales, but really it's the percent of credit sales, even though the method's name does not have that word in it. And the other method is called the aging of receivables. So now we're going to learn two ways to estimate that amount. So let's flip back to page 2. Okay, the first one at the top is the percent of credit sales. And this method is easier than the aging of receivables, but it's not quite as accurate. Because it's based on sales, which are on the income statement, as well as bad debt expense, we call this method the income statement method, as another way to refer to it. This estimates bad debt expense by multiplying the historical percentage of bad debt losses in the past by the current period's credit sales. So in our example here, the credit sales for the year are $200,000. The bad debt loss rate in the past was 1% of credit sales, so we multiply those two, and that's the amount of our entry, $2,000. And there's the same entry from page 1, a debit to bad debt expense, and a credit to the contra account, allowance for doubtful accounts. Remember, the reason why we have to use the allowance account is at this point we're estimating, and we don't know who is not going to pay us, and we don't know if that's actually the correct amount we're not going to get paid. We put in this contra account temporarily, and this will subtract from accounts receivable on our balance sheet the amount we think we won't collect. Now you might wonder what we would do if we were brand new and we didn't have an historical percent. Well, what you could do is join a trade organization for businesses of your type, and that trade organization would compile information from the various companies that belong to it, and they could share with you an average that companies in your type of business experience as a bad debt loss rate. Okay, so easy but not quite as accurate. The next method, the aging of receivables, is much more accurate because it focuses on estimating the ending balance on the allowance account, the contra account. And the way we do that is we examine every accounts receivable account, and we develop an aging schedule, which is a listing of all the accounts receivable amounts owed to us and how long they are unpaid. So for example, Adam Sports owes us $700. 400 of that is between 0 and 30 days unpaid. 200 of that is between 31 and 60 days unpaid, and 100 of that is between 61 and 90 days unpaid. If you add those three up, it comes to $700. And we do that with every one of our customers. So here's the total amount owed to us in accounts receivable, and that should match the general ledger accounts receivable account. Here are the amounts in each of those aging categories. If you add them all up, they come to $208,000. Now we multiply each aging category by the percent we think we won't collect of that category. So, for example, $120,000 is owed to us. We think we won't collect 1%, so we multiply that, and we get $1,200 that we think we won't collect. $45,000 is owed to us in the 31 to 60 day unpaid category. Of that, we think we won't collect 10%, so multiply that, and that equates to $4,500 we think we won't collect. So by multiplying by an historical percent for each category, we get a more accurate estimate. So now we're going to add across all the amounts we think we won't collect, and that comes to $15,500. That's the amount that should be in that allowance for doubtful accounts. That's the desired balance in the allowance account, what we want it to be. But there may already be an amount in that account. So let me cover this up for a moment here. And let's say my current balance for the allowance account is $14,200, and I want it to be $15,500. So I can subtract to find out how much more I need to add to $14,200 to get to $15,500, which is $1,300, and that's the amount of my entry for bad debt expense. The same entry we saw on page 1. But this method adjusts to arrive at the desired balance in the allowance account. So you need to know what that balance is before adjustment to be able to figure out how much you need to add in. With the percent of credit sales method, we never cared about the balance in the allowance account. We simply multiplied an historical percent by the credit sales to get the amount of our entry. Just a couple more issues, and we'll go on to a problem demonstrating these methods. We said we're using estimates, so what if our estimates are not accurate? Bad debt estimates always differ somewhat from the amounts that are later written off. To ensure bad debt expense and the allowance for doubtful accounts do not become materially misstated, that means significantly wrong, over time, companies revise overestimates of prior periods by lowering estimates in the current period. In other words, we do not go back and fix anything. We apply it from the current period forward. One more thing, and this deals with account recoveries. We're going to have a problem on this in a moment. The collection of a previously written off account is called a recovery, and we take care of it in two parts. And what we're saying here is we thought the account was a bad debt, that we would never collect it, and yet the customer comes in and wants to pay us. So what do? Well, we first reverse the write-off. Let's take a look at the write-off on page 1. There it is, a debit to the allowance account and a credit to accounts receivable. So we're going to do the opposite. We're going to put that accounts receivable back on the books by debiting accounts receivable and crediting the allowance for doubtful accounts. That will restore the customer's account on your books, and then you could debit cash and credit that customer's accounts receivable, as you always do when a customer pays you. The final item is alternative methods. An alternative method to the allowance method is the direct write-off method, and that records bad debt expense only when a company does the write-off. Now, this is not allowed under generally accepted accounting principles, but actually it's the method that the IRS uses in determining what our taxable income is. We're going to end this mini lecture now, and we're going to take a look at some problems.